question is, did February deliver the knockout punch, or does this bull market have a few more rounds left in it? That is the question that everyone is asking as the market continues to stagger following last month's 10% correction. So, will Wall Street get its legs back, or will it be down for the count in the very near future? And more importantly, how does that uncertainty impact you and your money? It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. So just when it looked like the stock market was going to fully rebound from that historic week-long plunge in February, it didn't. Yes, it regained some losses, but since then it's been one mini sell-off after another, with everything from inflation to the Federal Reserve to President Trump seeming to spook investors. You know, there are several different ways to interpret all this to prepare for what might come next, and that's exactly what we'll be doing on today's show. Helping me today will be renowned options expert Jon Najarian and Dr. Marc Faber, author of the popular Gloom, Boom, and Doom report. But first, let's take a closer look at what's up with Wall Street and what might happen next. February was one of Wall Street's wildest months since 2008. First, the Dow plunged more than 3,200 points, 12% in just 2 weeks, starting, yes, on Groundhog Day. Then stocks bounced back to life, recovering about 3/4 of those losses at their highest point. But then volatility remained high for the next several weeks. Then the final days of the month, more big drama. The Dow dropped another 680 points, leaving it down about 1,600 points from the record high in late January. In the end, all the major indices finished February lower, with the S&P 500 and the Dow Jones Industrial Average having their worst monthly performances since January 2016. The NASDAQ posted its weakest month since October 2016. And frankly, I was a little bit surprised by how the month ended. And you know, it takes a lot to surprise me these days when it comes to the financial markets. But coming off its second best January in history and following a record year, I would have thought that momentum alone was strong enough to ensure a pretty stable recovery. My initial belief was that we'd have another 6 to 12 months of an upward market, what we call the market blow-off, before a steep, long-lasting correction took hold. But after February, I'm no longer so sure about that prediction. If you've watched this show for a while, you know I firmly believe that a major correction is coming. According to the lessons of market history, it's long overdue. But timing it has been challenging because the unprecedented levels of artificial stimulus that we've injected into the economy since the financial crisis. The overuse of quantitative easing has altered some economic fundamentals, and so far managed to delay the course of history. But I'm convinced that it won't be able to change the course of history. Yes, that major drop will come, but the pressing question for everyday investors right now is, has it already started? To try to answer that question, let's look at the two basic approaches that analysts use to determine whether a stock should be bought or sold. The first is technical analysis, and the second is fundamental analysis. You see, with technical analysis, you're looking mainly at charts and graphs to determine market performance, economic trends, and all the relevant data. The theory is that all of market sentiment is baked into the cake of a chart. And with a clear understanding of where the market sentiment stands, and by being able to interpret these charts, you're better able to forecast where it's going in the future. Although you need extensive training in technical analysis to really interpret these market graphs and become an expert, anyone can recognize certain patterns if they're obvious enough. For example, it isn't too difficult to spot a pattern of chaos similar to what we've seen today and in the months and weeks just before the 2007 to 2009 crash. Let's talk now for a moment about the second type, which is fundamental analysis. Fundamental analysis is more of what's considered a traditional analysis. They look beyond the charts and graphs and focus on the data that might be influencing the market sentiment. Specifically, they look at three types of financial statements that every company has to share: their balance sheets, their income statement, and their cash flow statement. By using data from these statements, they examine a company closely and compare it to its competitors within its particular industry. They can also do a year-over-year comparison of the financials of a particular company to see how it's trending. For example, fundamentalists look at things such as each company's price-to-earnings ratios and compare those ratios to PE ratios of other competitors within the industry. You can also look at average PE ratios of the stock market overall to determine if they're on the higher or lower end of the historical range. So let's focus for a moment on this one important piece of data used by fundamental analysts and see what it might tell us about the state of the markets right now. There actually has been very little argument lately among experts, and for some time now, that stock prices are overvalued in relationship to corporate earnings. You've heard me discuss many times the need for markets to make fundamental sense at some point again in the future. And that comment has a lot to do with PE ratios being fundamentally out of whack. Consider for a moment that the stock market grew by about 20% in 2017, while corporate earnings and GDP growth for the year, according to the Bureau of Economic Analysis, was just 2.3%. Given that disparity, the trailing PE ratio for the S&P 500 right now is about 22 times earnings. And as I've explained before, these are only two potential ways that the markets can make fundamental sense again when PE ratios are high. The first is that corporate profits can quickly catch up with overinflated stock prices. Now, this hardly ever happens. The second is that prices can shrink back down to align with profits. And that's exactly what's happening when markets experience a major sustained pullback. In other words, fundamental analysts would read high PE ratios as a potential warning sign that the markets are irrational, and they're fundamentally in need of a major correction in order to make sense again. From a historical perspective, that conclusion has proven to be consistently accurate. I'll talk a lot more about that in just a bit, and about another index for measuring PE ratios that's sounding an even louder alarm about the stock market right now than all the other fundamental analysis methods put together. But again, the more important question for you is this: has the next major sustained pullback already started? Or at the very least, could the market's persistent unrest since early February be a sign that it's about to? Well, no matter how you approach the data, no one can know the answer for certain, of course. But as of now, I believe there's enough evidence pointing to that possibility that investors should take note and probably take some type of action. Even if you're an aggressive investor and you feel comfortable gambling that the market's going to find its legs again and go on fighting for another 6 to 12 months, I would say at the very least you should consider hedging your stock market positions. We'll talk a lot more about hedging later in the show. Right now, let's welcome back our good friend, Jon Najarian. He is a man we always feel fortunate to have when talking about the financial markets. Jon Najarian started his career as an options trader at the CBOE in 1981, following a stint as a pro football player with the Chicago Bears. Jon and his brother Pete are the co-founders of OptionMonster.com, a provider of market intelligence, commentary, and strategies. He's a regular on CNBC's Fast Money and is always in demand as a speaker and market analyst. Jon, welcome back to the show. It's good to have you.
Great to be with you, David. Thanks for having me back.
So tell me, generally speaking, what's your take on what's happened with the stock market starting on Groundhog Day of this year?
Well, yeah, it seems that the market really had gotten ahead of itself in January, David. I know you've said that, and other astute market watchers have said that the trees don't grow to the sky. You don't just put on 100 points on the Dow Jones Industrials every single day for a month straight, which is more or less what we did. Yeah. And you haven't had any corrections of any significance in years. So we were due for some volatility. Boy, did we get it in spades. And then we had a bunch of reasons, like, for instance, the departure of Gary Cohen and other things that have happened recently, tariffs and the like, that have sort of given investors pause, I'll say.
Mm-hmm. So I know you talk about January, but even if you look back throughout all of 2017 being a 20% plus year, 30% depending upon what index you're actually quoting. The question is, how much of these drops, how much is volatility that occurred in February really came from the news? Or is it really just, as you said, the market getting out over its skis over the last maybe even more than a year? And these particular newsworthy items are really just an excuse for the market drop by the Monday morning quarterbacks.
Well, I think it was that the market was very robust and very strong. And a lot of that I give credit to President Trump and some of the rollback in regulations, obviously continued low interest rates. But that, David, is what changed on Groundhog's Day, as you're saying, because all of a sudden we saw a pretty big jump in interest rates. And when you're talking about rates that back in November were 2.25 for the 10-year rate, and all of a sudden it touches 2.90 very quickly in February, that was something that was a wake-up call for the market. If all of a sudden I can make almost 3% on a 10-year instead of 2.25%, that's a little bit more of a draw of capital away from the stock market. Doesn't mean everybody should leave, but that was a wake-up call, I think, for investors.
But what do you think was different then? Because we saw a 75 or 80 basis point jump in a month or 6 weeks right after the election. But it was hardly a hiccup on the stock market, on the bond market. But all of a sudden this time, a 60 basis point jump, it really affected both stock and bond markets. So why do you feel like it was different this time from maybe 14 months before?
I think 14 months before, we still had the Fed that was basically at zero interest rates. And since then, they've moved now 5 times. I mean, they've taken the Fed funds rate up to, over 1%. And I think, David, that tells me that when we pull back, we can't pull back as far, because when the interest rates were zero, you could pull all the way back towards zero. And we'd seen, not the 10-year, but we'd seen the short-term rates do exactly that. Now, when we pull back, we're pulling back towards that 1 or 1.25. That's as far as we can go. So I think that's why the market just can't fight the Fed as much now at 1.25% rates as it could when the rates were zero.
So it sounds like you're saying that you thought that it was, the market seemed to think that was more of a temporary thing after the election because short-term rates weren't below it supporting it. But now that short-term rates are supporting it, the markets are saying, uh-oh, this is permanent, not temporary. So we need to take a quick commercial break. We come back, John, I want to ask you a little bit about how that affects stock market valuations and what your anticipation is of the months coming up in terms of market volatility. So and you stay with us also. We'll be right back with a lot more in terms of words of wisdom from my good friend, Jon Najarian. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Now, if you've been watching our show for a while, you may recall the episode in which we spoke with Nobel Prize-winning economist Robert Shiller. Dr. Shiller is best known for his creation of the cyclically adjusted price-to-earnings ratio, or the CAPE index, which has become an essential measuring tool for many market analysts. The CAPE offers a more telling picture of PE ratios because it adjusts for inflation, and it uses 10 years of earnings data to determine a company's relative earnings to its relative stock price. The point of this approach is to smooth out the data by adjusting for inflation as well as any cyclical patterns over time. As with more fundamental approaches to measuring PE ratios, higher readings on the CAPE index are considered to be a potential warning sign that the market just might be fundamentally overvalued and due for a correction. The higher the readings, the more out of whack the markets are considered to be, and the bigger the possible impending pullback. In addition to its real-time use, though, the CAPE has been used to measure the status of PE ratios throughout stock market history. With that in mind, everyday investors should be aware that the CAPE is currently at 33.4 on the S&P 500. This is its highest point since before the October 1929 crash that spawned the Great Depression. The only other time it's come close to that was just before the bursting of the dot-com bubble in the year 2000. In other words, according to the CAPE index, the market isn't just overvalued right now, it's dangerously overvalued. and standing roughly where it stood right on the brink of 2 historic market crashes. And as you know, I put a lot of stock, no pun intended, in the value of history as a forecasting tool. So allow me to share another important historic point about the current status of price-to-earnings ratios to consider alongside the CAPE index. Historically, before the end of every long-term secular bear market cycle, like the one that I believe we are still in, price-to-earnings ratios have always shrunken back down into the single digits. Earlier I noted that at present, the average PE ratio for the S&P 500 are around 22, which is obviously nowhere near the single digits. And to me, that's clear evidence that the long-term secular bear cycle that began in the year 2000 still has several years and at least one more major market correction to go before it's over. And again, I believe historical precedents will win out despite the fact that the market has appeared to be in recovery since 2013, thanks especially to the influences and impacts of this artificial influence we call quantitative easing. In looking at both the technical and fundamental evidence, I'm expecting a drop of at least 40% and a drop that could possibly be as steep as 70%. The 40% would get us below what technical analysts would call our previous resistance level, according to all the chart data. But in order for PE ratios to get back down to single digits and to make the fundamentalists happy, we need close to a 70% drop from where we are today. So you could actually read the minimum drop again as a forecast based on technical data, and the 70% is a forecast based upon fundamental data. But either way, the outcome could be devastating for investors who get caught in the downdraft, especially those who are retired or within 10 years of retirement. So, bottom line is simple. Even if you're an aggressive investor, willing to gamble that this 40 to 70% correction is still 6 to 12 months away, I would still recommend that you do something to slightly mitigate your risk, perhaps in the form of hedging. Now, if you're retired or within 10 years of retirement and you're hedging instead of selling, I would urge you to consider that you're still taking risks that you probably can't afford to take. But again, if you have money that you won't need for income for many years out and you want to take that chance, then the choice is yours. But at bare minimum, do something to protect your downside, i.e. hedging. And we'll talk specifically about different ways you can hedge coming up in just a bit. First, let's welcome back Jon Najarian. Jon, thanks for sticking around.
Great to be back.
Well, glad to have you as usual. And I know last week's show we talked about this, and I know you saw it because I know that you sit home every Sunday morning and you watch our show here on Newsmax. But we talked about the fact that it's funny because everyone talks about how interest rate increases affect the bond market. But in some ways, interest rate increases have as much of an impact on the stock market as the bond market, because the stock market is really a discounted future earnings flow. So what do you think this interest rate trend means for the stock market over the next few years?
Well, what I've liked to say, David, is that it's the acceleration or the speed, the velocity of interest rate increases. We all know that the Fed is going to be increasing rates unless something bad happens, which obviously none of us are rooting for that. But when we see that big jump, you said after the election that we had that 60 or 70 basis point jump in the 10-year. You're 100% right. It happened very quickly again from November of 2017 till basically the first week in February. And it's those quick moves that startle the markets. So I think overall it's undeniable that interest rates are going higher. But I think if they go higher at a slow and measured pace, I think that's something the market will tolerate. The market won't tolerate it if they go up quickly.
Yeah, and it's interesting because the Federal Reserve, I believe, they're smart enough that they're not going to have quick short-term hikes in interest rates. But the long-term rates stimulated by the markets, you just don't know. And this one we had in the past month was obviously just the bond market itself reacting quickly. So I guess the question is...
Exactly right. That's why we watch it.
Of course. And Jon, I guess the question then is, what does that do to investors psychologically? You know, a football team with an offensive coordinator and no defensive coordinator doesn't make a very good football team, right? Well, the problem is a lot of investors over the last year seem to have forgotten about defense. It's almost like defense doesn't matter. we're just going to get the ball, we're going to throw it down the field, we're going to score a touchdown every time, don't worry about defense. So were they unprepared for this market pullback? Are they unprepared now? What are your thoughts to that?
Well, we all saw in the Super Bowl that Tom Brady scored as often as you could possibly score in that game, threw for 500 yards, and they still lost. So to your point, you do have to be able to do something more than just score frequently. You do have to have a defense. So to take it back to the stock market, I think a lot of people could just have thrown money at the market in 2017, and they were going to be up 20% or more unless they just really picked the dogs that were out there. They could do much better than that, of course, if they picked the right stocks. However, I think that kind of spoils people. They think, oh, anybody can do this. What do I need to pay David for? What do I need to pay John for if I can just throw money at the stock market and make 20%? That changed in February. Now there's a lot more demand for people to get a little help,
Sure.
Whether it's defensive help or whether it's advice that, hey, it's a good idea to take a little off the table here and look for another spot for some of these assets.
Well, you heard me say, don't try this at home, and that's exactly the point here. Do you think the volatility is going to stay at this higher level throughout the rest of 2018 as a best guess? I mean, I know you don't have a crystal ball, but what are your thoughts on that?
No, I don't think it's going to stay high. I do think that if we see that acceleration that you and I talked about just a moment ago, if the velocity of change in interest rates is high, then we'll see high volatility as well. If we don't, then I think we won't be as low as we were in 2017, which was, I think, the lowest year on record for volatility. But I do think volatility will be more in that 14 to 16 range, not in the mid-20s that we just saw a week ago for the VIX. Yeah. 20
seconds or less. You think the market has more downside throughout the year of 18 or more upside at this point?
I think it's got more upside in 2018. I think that when Joes and Janes start cashing those bigger checks from the tax cuts, I think that will be a driver as well as corporate profits, David.
That was my opinion going into beginning of February and when the drop first started, and I'm questioning it a little bit now, but hopefully you're right, John. So, John, stick with us. We'll be right back for one more segment. Again, even if you personally believe that the stock market may have 6 to 12 months ahead of us, enough legs to last that long and maybe go up another 10 or even 15%, I strongly recommend having some kind of protection strategy, some kind of defense in place. And there are several different ways that you can hedge against losses. But let's talk about some of the most common ways. First, you can watch the markets daily and keep one finger on the trigger, so to speak. That, of course, requires diligence, but you're still only guessing as to what the daily fluctuations might indicate. A problem, though, is that it enables an individual to make emotional knee-jerk decisions that could be badly timed. Plus, it can be especially nerve-wracking in a period of high volatility like what we're seeing right now. But I know that some people actually enjoy that kind of drama, so if that's you and you enjoy that type of drama, then this might indeed be a viable way to hedge, just so long as you're not gambling with life savings or savings that you're going to need in the short term. But you can also hedge a little bit more scientifically. For example, you can hedge by diversifying into stocks that don't correlate as much with the overall stock market. They don't have to be foreign stocks per se, just equities that don't correlate as closely with the overall U.S. market, and therefore are less likely to take as big of a hit when the next major market correction hits. Next, you can hedge by doing something called trading a stop loss. To put it simply, that means you put in a standing order with your broker that if a stock drops below a certain price that you want to sell it. For example, if a stock's currently worth $25 a share, you might want to put a stop loss that ensures it gets sold if it drops below $21. That takes the emotion out of it and helps you minimize that loss. But be aware, though, that it's not a perfect hedging strategy. The trouble with a stop loss order is that the market can drop fast and furious, and stop loss orders are not the highest priority when trade orders are getting filled. Regular market orders get filled first, and sometimes stop loss orders end up not being executed simply because they're the low man on the totem pole. Theoretically, though, a stop loss provides you some hedging protection on the sell side. Now, in a similar way, you can institute limit orders to protect yourself on the buy side when you're entering the market. As you can probably guess, that's in order to buy a stock at a specified price or cheaper. This at least helps you adhere to the first basic rule of investing, buy low. But again, like stop loss orders, a limit order is not the top priority and might not get filled. The next hedging strategy I want to tee up before I talk more about it with Jon Najarian is options. Options trading is a specialty, and our guest today is a specialist in it. So I want to leave plenty of time for him to share his expertise. Very basically, though, there are two different kinds of options trading. First, you can buy a put option. The owner of a put has the right, but not the obligation. In other words, has the option to sell a stock at a specified price by a predetermined date to a specified buyer. The name comes from the fact that the owner has the right to put up for sale the stock or the index. For example, if you own a stock worth $25 a share, the options price, for example, might be $20 a share. That means that if the value of the stock drops below $20 for a share, you can force someone to buy it from you at $20. So the put option hedges your downside. Or you could do something called writing a call option. That gives another investor the right, but not the obligation, to buy a stock from you at a specified price within a specified time period. The name comes from the fact that he has to call in his order to buy the stock from you at a certain price. So obviously a call option doesn't protect your downside as much as a put option per se, but by writing a call option, it increases the income you receive because you're selling the option to that other investor. So if that major drop does hit, your increased income at least softens the blow of the capital losses. And again, I can't stress enough that none of these hedging techniques are foolproof, and you probably shouldn't be trying them with any money you're going to need within the next 10 years. If you have money that you need in the next 10 years, you're probably better off just simply selling, liquidating, taking your winnings off the table, and not letting greed get in the way. You also really have to know what you're doing, or have someone who does in charge of executing these hedging strategies on your behalf. The bottom line, as I always like to say, is that if you don't have the right expertise or experience, don't try this at home. Speaking of experience and expertise, let's welcome back Jon Najarian. So Jon, what do you think for most investors then in 2018? Do you think it's more of a, running the ball 3 yards, 4 yards, and that's it? Or do you think more of it's, passing the ball 15, 20 yards down the field, trying to get the first down all in one fell swoop?
Well, I think there'll be a lot of the latter because of M&A, David. So in other words, we've seen this year already a number of big deals announced. I mean, Cigna going after Express Scripts, a $67 billion deal. I'm not saying they'll all be that size, but I think you'll see those kinds of jumps out of the companies that are being acquired. So to your point, to me, that's more like throwing the ball downfield.
Sure.
I think for a lot of stocks, though, like Apple, I think it'll be, 3 yards in a cloud of dust. But I think they just keep thumping away and going small moves higher for a lot of the Dow Jones Industrial stocks.
Okay. So let's talk about hedging then. Like I said, I was thinking that we're going to have more of a blow-off throughout this year and maybe even 2019 when the first pullback happened right around Groundhog Day, as I said, and then I've been starting to question that a little bit more. So let's say that people watch my show, so they kind of agree there's a great chance that we're going to have more of this uptick, but they want to be cautious. They want to hedge. What's the best way today for you to recommend people hedge with the volatility? Stop losses or options? Are the options too expensive?
I'm always going to say options, David.
I kind of thought you might.
Question, I know, because you're a smart host. But yeah, I'm going to say options, and I'm probably going to say options on the S&P 500. Those would be puts. So with people with exposure to the market that have stocks that are S&P 500 or S&P 500-like stocks, then I'm going to buy some out-of-the-money puts in the S&P 500 just in case. I think for the same reason you want that kind of insurance on your car or your house. Mm-hmm. And just like the insurance on those, you hope that you don't crash your car and that those puts go out worthless. I don't want to root for those puts to explode. I want to root for them to go out worthless. So I think the market continues to grind higher, but I'd like to have a little protection. That would be my hedge.
So, you know, what's your best guess if you were hedging in a blanket way with the S&P 500 today? How far out would you go, and what percentage below current market value would you put your strike price? Just give us some feel for that. Sure.
I would, and I routinely do this for customers, I would, or our team does, technically, I don't, but we buy usually 2 to 5% out of the money puts that are usually 2 to 3 months into the future. So in other words, if we're talking here in March, I'm usually picking something that's more like a June timeframe, May or June, and I'm picking several strikes out of the money in the S&P. They're cheaper then, and the time decay is going to be very slow on something like that. The nearer term options look cheap, but they're really a lot more expensive if you figure how many times over the course of the year that you'd have to buy them.
Yeah, and I guess if you get a bigger pullback, so the option's now in the money, you could always turn around and sell that and create a gain at that point too. So there's ways to hedge, and you could flip it into a great way to be speculative and make money. So that's all good news. And John, we have to leave it there for now. I appreciate you being with us again today.
All right.
You know, it's more saying that time really does fly when you're having fun. So John, thank you.
It did. Thank you, David.
And you stay with us also. We'll be right back in just a bit with our next guest, Dr. Doom himself, Marc Faber. So stick around. We've discussed options trading as a hedge against the possibility that a major market correction is at hand. But of course, there's another option, and that is this: to use this time when the warning signs are mounting as a motivation to make the shift from growth-based investing to income-based investing. If you're retired or within 10 years of retirement, I believe you should be making that shift anyway. In the spring of 2007, the market had, at one point, its worst week in 4 years, with all the major market indices losing between 4 and 6%. And yes, months of volatility followed this. But what did the Wall Street cheerleaders do? They ignored the growing warning signs, and the irrational exuberance continued in the markets. In October 2007, in my personal newsletter to my clients, I called attention to the warning signs and encouraged clients to use those warning signs as motivation to lower their risk if they hadn't yet done so already. Of course, you already know what happened next. The market peaked on October 9th, and weeks of volatility followed before it went into a 2-year plunge that reached nearly 60%. Many investors who hadn't reduced their risk were wiped out, with some even having to postpone retirement or come out of retirement and go back to work. And finally, since we've talked so much about PE ratios today, I'd like to reiterate this point. If the current market really is recovered from the secular bear. It would be the first secular bear market cycle in history to have accomplished that feat before price-to-earnings ratios have shrunken back down into the single digits. It would hold a spot in the Guinness Book of World Records as the first such secular bear cycle to have done so. And oh, by the way, it would also have two other spots in the book, as A, the shortest cycle in history, and B, the first to recover with fewer than at least 3 major corrections and market drops within it. So, if you're still feeling the pressure to ignore the evidence and to hang in there, ask yourself, what are the odds of anyone or anything setting 3 Guinness Book World Records? The answer, of course, is quite slim. Now it's time to welcome my next guest, Dr. Marc Faber. Marc Faber publishes the widely read monthly investment newsletter entitled The Gloom, Boom, and Doom Report, and is widely known himself as Dr. Doom. He's the author of several books, including the bestseller Tomorrow's Gold, Asia's Age of Discovery. He's a popular speaker and a regular contributor to leading financial publications around the world. Dr. Faber, welcome to the show.
Well, thank you very much for having me.
So, your approach to investing has been described by many as being contrarian. Where do you think that definition is accurate, and where do you think perhaps it's not?
Well, I think, yes, it's to some extent accurate in the sense that I'm always looking for areas in the market that are neglected, and I'm avoiding popular themes.
Now, I know that, you have a little bit of a reputation by some, the Dr. Doom moniker, by some as being a bear.
Yes.
Were you predicting this volatility that we started to see and starting on February 2nd? Did you see that coming? And if so, why did you think it was going to happen?
Well, I mean, we had an extended period of extremely low volatility. I mean, the S&P went up for more than 2 years, from February 10th, 2016 to the end of January, with never more than a 3% correction.
What do you see coming up now? Do you see this 10% was enough to kind of shake off all the people who were perhaps too aggressive or too bullish, and maybe now we end of the year higher? Or do you think this is just the beginning of a lot more to come, a lot more bad stuff to come in 2018?
Well, there are many factors that will influence prices, but one thing I have to point out, the market celebrated 2 days ago the 9th anniversary of the low on March 6, 2009, when the S&P sold off. It became oversold and reached 666. Now we went to 2,872, again in a blow-off, but this time on the bullish side. So we became very overbought. So it's like a mirror image.
Does this remind you at all of maybe what we saw in early 2000 or what we saw in late 2007? Are you drawing any comparisons to those times, or is it just me?
No, it's not just you. I think 2000 was a top in the market, mostly for technology stocks. And at the time, as you may remember, some basic industries and commodities like oil and precious metals, they bottomed out. So when the technology bubble burst, other stocks came up, like mining companies. They didn't go up, but they didn't go down. But later on, they went up very strongly after 2003. And so I believe that we are at the juncture where all asset markets may come under pressure, because it's not just a bubble in equities. We have a bubble in bonds, more so probably than in equities.
In fact, Dr. Faber, we talked about that a lot in last week's show, the bond market and the interest rate hike. Marc, we need to leave it there for just a minute. We're taking a commercial break. We'll be right back with a lot more from Dr. Marc Faber. Stay with us. Welcome back to The Income Generation. I'm David Scranton, here with Dr. Marc Faber. Thanks for sticking around. Right before the break, you were talking about the bond market and interest rates. And that's actually a great point. Last week's show was on that. But You know, everyone's talking about how interest rates are going to affect the bond market. But again, is it just me, or interest rates should affect the stock market adversely just as badly as the bond market? But why is nobody talking about that?
Yes, I think that's an important point. Personally, as of today, I would rather go long the 10 years Treasury note that yields 2.85% than go long the S&P, because it depends on your outlook for the economy.
Sure.
My outlook for the economy is in June of this year, the expansion will be 9 years old. This is by historical standards among the 3 longest expansions that the US ever had. We've been expanding at a modest pace, but it's been driven by a not so modest debt expansion and money printing, and that is not sustainable in the long run. So I think the economy will actually disappoint, and then the stock market will be more vulnerable than the bond market. I think the bond market may rebound. We most likely will not see new lows on the 10 years. The low was in 2016 at 1.37%. That is unlikely to happen.
Sure.
But I think we can rebound, and I think stocks are, as you say, if I'm wrong and interest rates go up, I think stocks will be very vulnerable.
So in the 1 minute we have left, what has to happen in the stock market for you to become bullish again? Do PE ratios have to get to a more reasonable level? Talk to us about that.
I think I like to buy stocks, and I did so after a decline that was major, like 2000, March is the peak. The low was in October 2002 and March 2003. March 2003, we had one condition fulfilled. The length of the bear market was essentially 2 years. Same, 2007, a peak, and then we went down. By March 2009, we were also down for 2 years. And we were down like in 2000, 2003 by almost 50%.
So in 10 seconds or less, tell us, does it have to be down 20%, 30%, 40%? What's the number that gets Dr. Faber to be bullish again?
Well, I think in the case of the US, minimum 30%.
70?
30.
30.
Minimum.
Oh, good. I'm glad you corrected. My minimum number is 40. Yours is 30. Dr. Faber, we need to leave it there for now, but thank you so much for being on the show. And you stay with us, too. We'll be right back. We'll wrap everything up, put a bow on it in just a minute. I'd like to thank both of our guests for joining us here for another episode of The Income Generation. More importantly, I'd like to thank you, our new and returning viewers. You know, there's little doubt that the stock market may have turned a crucial corner in February. The 10% correction and ongoing volatility are certainly a change from the relative smooth sailing and all those steady gains we saw throughout most of last year and on into this January. But please, let's keep in mind that what's happening now makes fundamentally more sense than last year's 20% market increase based upon hope and optimism. Yes, the markets have finally started to reflect reality again, including the fact that stocks are significantly overvalued relative to corporate earnings. As we saw a moment ago, according to the Shiller CAPE Index, the market as a whole is dangerously overvalued. There's plenty of other evidence, both technical and fundamental, to suggest that the third major correction of our current secular bear market cycle might be at hand. If you trust the evidence, then please, please, please use it as motivation to reduce your market risk and to make the shift from growth to income-based investing. If you're still skeptical and think the market may stay on its feet for another 6 to 12 months, then once again, for the last time, at very least, consider some sort of hedging approach. Or more accurately, relying on a trusted, qualified expert to hedge for you. Just keep 2 things in mind. Number 1, no hedging method is foolproof. And if you're retired or within 10 years of retirement, again, I believe that you're still taking unnecessary risk by hedging instead of just selling and taking your winnings off the table. Because again, history tells us that a third major correction of somewhere between 40 and 70% is destined to happen. And right now, A lot of evidence is suggesting that it may happen sooner rather than later. Thanks for watching. And if you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the income generation. I'm David Scranton. Thanks again, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.